With this glass half empty mood which is prevailing in the marketplace, there was particular focus on the weekend on a US report by the Economic Cycle Research Institute. It said a recession in the US is unavoidable and there's nothing policymakers can do about it. The Institute has credibility. It hasn't sounded a false alarm in over 20 years. That report helped to top off a quarter that saw Wall Street suffer its worst fall since the depths of the 2008 financial crisis. But of course, equities pain as Treasuries gain, and the 10-year yield for Treasuries in the US closed Friday at 1.91%. Brad McFadden from the Daily Trading Report says the US Treasury market is a time bomb just waiting to go off. He joins me now, and of course, George Barbaros still with us in studio this morning as well. But Brad, thanks for joining us on the program. I guess you could give us perhaps to start off your take on the current state of economic affairs in the United States. Is it as dire as that warning sounds from the Institute?
Oh, well, it's not particularly good, but it's actually not as bad as what they make out as well. You know, a lot of what's going on right now is pricing in the very, very worst. If we look at the yield differential between what Treasuries offer and what equities offer, it's up there. Well, it's more or less the worst as what it's been in the last 40 years. So, yes, recession, Greece, yes, it's all priced in. The question is what's not priced in.
And people continue to, it's all about search for yield now. People seem to say, have that discussion about whether US Treasuries can go even lower than they are now. You've been looking at a couple of scenarios for the US economy. Just take us through some of those and what you see the likely outcomes are.
Well, the US can't really afford to go into recession. Now, with their high borrowings, if rates increase, they're in dire straits, so they've got to keep rates low. Now, what's likely to happen if we see a recession in the US, then the ability to, obviously tax revenues will come down quite dramatically, and they're in dire straits. So the end scenario is that the Fed will do all that's possible to keep the US out of recession and keep liquidity in the system.
And the outcome being for Treasuries then, how do Treasuries track through that?
The ultimate outcome is inflation, and that the worst enemy of Treasuries is inflation. And what you're seeing right now is inflation tracking higher, quiet on the sidelines while no one else is looking. And it's quite interesting that you're getting, what, 1.8% now in the US 10-year and 3.8% of inflation. So you're actually worse off by being in Treasuries. Okay,
so you say yields have to go higher?
They have to go higher.
People will just start to get out of Treasuries?
They have to go higher, yeah.
George, is there an upshot there for equities? If that's a trend, and from what Brad says, it's kind of unavoidable in all the scenarios you look at, we have to see higher US Treasury yields. Firstly, do you agree with that? But also, what does it mean for equities?
Yeah, I suppose I would always state that the US bond market is the global bond market, it's the global average. Whatever the rating of the US bond market is, everything must be rated that or lower. It can't be the reality, and the price of long bonds in the US reflect that. The price of long bonds in Germany and Switzerland reflect their situation. Brad's right. Inflation is the best thing if you're an issuer of a bond. If you're a holder or investor of a bond, it's the worst thing. So if the US can create economic growth and inflation, it's the perfect way to get out of this massive $14 trillion debt. And that's the perfect scenario. And that's what they're trying to engineer as much as they can. But it's different stages and phases of it. Operation Twist, what is it? Grab, a few $100 billion in the short end. They're keeping rates zero for 2 years anyway. And buy on the long end. And encourage people at 3% the 30-year rate to go out and borrow some money and buy a house or do something with it. That's what they're trying to encourage to get that cash off the balance sheet and to lend it, because it's all about credit. Credit drives activity, credit drives earnings, credit drives momentum, and you've got to get that money out. And then if they can do that, because as Brad said, the unemployment rate, the inflation rate is elevated, they've still got negative real yields, and when that indicator of a negative real yield, unlike Japan in our mind, drives the potential for activity going forward. It puts the risks in activity re-accelerating going forward, and that sort of supports a corporate balance sheet. Yeah. But yeah, higher yields, you'd have to think going forward, they're just too low, but they're obviously indicating that there's some concern there. And that is why people in North America are buying S&P 500 for the dividend of a 2.4% dividend, which is risky strategy, but they need income. Yeah. After 2 years of no interest rates, you do need income somewhere, and that's where they're driving towards that income source.
Brad, as you said, inflation is the enemy of someone invested in Treasuries, of course, but there was a lot of ifs in what George was saying. He also mentioned Japan, because there could be an argument that the US actually ends up in a deflationary kind of situation like Japan, and what's the likelihood of that?
I think if you look at the Japanese, have had, what 4 prime ministers, 6 prime ministers in 6 years? I'm losing track now.
Me too.
They just don't really have the, I guess, the ability to put the hammer down, unlike in the US. The Fed's very, very determined to create inflation, and they're going to get it. They're going to increase their inflation target. There's something else that's quite important as well. Being invested in treasuries, US treasuries, or I should say global treasuries, is a very, very crowded trade. It seems like every mum and pop right now is fully invested in the treasury market and have really dumped equities. And as I said, valuations in terms of the spread between yields on equities and treasuries now are more or less at, 40-year highs. Now, of course, that can get higher, but as a medium to long-term investor, I'm not going to bet on it.
Now, as an Australian, maybe Australian retail investor, it's probably unlikely I'm directly buying and selling US treasuries, right, George? So what are the implications for the general, audience out there for us?
Oh, they can do that. But
it's not. I don't think it's a big participation, is it?
No, it's small. But they're doing it via their super funds that they have with their work agreement through the international fixed income weighting, which is, sorry to bore you, is benchmarked to the Barclay Global Ag Index, which is similar to composition to the domestic market. They do have US treasuries in there. They're just very, very expensive. Well, it's a hard thing to explain in a very short time, but duration risk means that if a 10-year bond moves up by 10 basis points, I'll make more money than if I had a 1-year bond. If it moves down by 10 basis points, I'll lose more. It's a leveraged impact. So people need to be cognizant of the duration risk, and that's where you get these massive capital gains. That's why the Aussie bond market's up 10% rolling 1 year. It's got capital gain. The income's like half of that. So there's so many things to consider. But it is a crowded trade, I agree with Brad. It might be crowded for some time, but every valuation, earning yield, bond yield, when you do the reciprocal or the multiple, it just says that the equity market is extraordinarily cheap. They're just going to be cheap for some time, but there's quality, and we don't sell the quality. We hold on to it and rebalance those portfolios. And traders around the margin have got plenty of opportunity to buy vol, sell vol. The buy vol trade just seems to be another one that everyone seems to be onto at the moment. I'd be probably getting ready to sell some vol, but you might be a bit brave there. But there's some crowded trades out there. But making money slowly through having a well-diversified portfolio with quality, you don't have to worry about that.
Brad, just to finish off with you, what is the trade, or what's the broader message, and again, maybe for people not directly buying and selling US treasuries, maybe they're not kind of into that area?
Well, it's some very, very exciting times right now for equities. Just take European equities, for example. I mean, everyone wants to avoid them like the plague. French equities are trading at book value. German equities are trading more or less at book value. Japanese equities are trading, or the average Japanese equity is trading at about 0.6 of book value. So really, these things are priced to be, they're worth more dead than alive, many of these equities, to be quite straightforward. So it's a very, very exciting time to be invested or be looking at opportunities, particularly where no one else wants to. European equity markets and Japanese equity markets.
And as we were chatting about with you, George, earlier, you've got to go offshore to access some of the opportunities you just can't get from the local share market.
We've got our biases,
yeah, it seems to gel in with what you were saying earlier.
Yeah. Search for it. There's always opportunity, as Brad was saying.
Yeah, perfect. We've got to wrap it up. Thanks so much, hey, George, for the whole program. We appreciate it, from UBS. And Brad McFadden, we appreciate your time. Good to see you on the program too. Let's take a break at that point. We do have Market Express coming up for you, so stick around.